Hey guys, it's Jamin Kirkwood with Secure Financial Management, and I want to get out a quick video. It's going to be a little bit different than normal, right? I'm actually going to break this up into two parts. I want to talk a little bit about what's been happening recently in the markets. It's been a really good, strong 4 to 6 weeks. You've probably seen that in your accounts, and everyone's very happy right now. A nice change from what happened around this time last year. And the second part, I want to talk about looking forward and answer some questions and get into to some discussion about a lot of questions we've had coming up, and many of you have had them, I'm sure, as well, about recession and what the possibility of that is, and how we might look at preparing for that. Okay, so we'll talk about that in part 2. What I want to talk about right now is what's been happening in the markets recently, and why things have been going pretty nicely for us, right? So a lot of the times when we have earnings season come out, I tell you guys, hey, whatever happens in the markets in the next few weeks, it's very likely tied to earnings. Exactly what's been going on here. Okay, so we had Q3 earnings come out over the last few weeks, and they haven't been amazing, but they haven't been as bad as what people were fearing. It sounds kind of weird, right? It's like they weren't great, they just weren't as bad as what was being anticipated. So that was enough to stabilize the market and take us to new highs. There's been a lot of new highs set recently, and a lot of the reason for it has been the performance of the earnings reports that came in over the last couple of weeks. Also, the Fed has they did a cut, right? The Fed did a quarter point cut a few weeks ago, and the follow-up to that was basically, we're not going anywhere for a while, right? We're not going to look at raising rates for a while. Their statement was along the lines of, it's going to take a substantial change in what we see for us to move rates higher at all. Significant inflation, which we haven't gotten, and usually inflation's caused by wage pressure and stuff like that, and we're not really seeing a lot of that either. So the stock market likes that, and investors like that. Hey, earnings not as bad as we thought they were going to be, and also that the Fed they call it the Powell put, right? Jerome Powell is the head of the Federal Reserve. The Powell put, a put is a term for like basically stabilizing the markets or stop lossing your investments, and they're saying, hey, this is the Powell put, we've got that there for a while. So things looking pretty good right now. I talk to you guys a lot about inflation, about unemployment rates, things of that nature. All those things are very stable and everything looks good for the markets. I always say to you, right, that anything can happen at any time. There's systematic risk built into the markets. And that will always remain. But the things that we can measure, they look pretty good right now. And fingers crossed, we're not going to have another December like we had from last year, December of 2008, where we had almost a 20% correction. And that's where I want to lead into part 2 of what I'm going to talk to you about. Okay, is there's a lot of concern going on, like, hey, we haven't really had a correction in the stock market for quite some time. We've had no recession for a while. Growth has been going along. How long can this last? Well, the one thing I would say is that we really did have a correction last year, right? Christmas Eve of 2018 was the bottom of that downturn that had been going on for about 8 to 10 weeks. It started in October, bottomed out Christmas Eve. And a correction technically is viewed as 20%, or a bear market is viewed as a 20% downturn in the stock market. We got to 19.7. I'm just going to call that 20%. We'll round it up, right? So I would say that we have had corrections like that along the way. It's very quick. That's the thing, right? It's happening quicker than it ever used to. And I talked about this in a video of mine a little while ago, that trading's happening quicker than any of us can do it, than any human can do it. It's all being done by machines and algorithms. And so the corrections and recoveries of the past that you might have thought about 10, 15, 20 years ago that would drag on over a long time, they're still happening. They're just happening a lot quicker. So I would argue that we have had a 20% correction over the past 18 to 24 months. So it's not like we've just gone up in a vertical line the whole way, right? And where I want to leave this before I go into part 2 is that there's going to be a recession, but it's not that simple. There's more to it. Join me in part 2 and I'll expand upon that a little bit more. Again, guys, none of this should be taken as a recommendation. If you have anything you want to discuss about your investments or your portfolios, please give us a call at the office, 210-428-6250. See you in the next video.